Rick Santelli is in Chicago. Rick, you got the consumer sentiment numbers were terrible. You got the job numbers yesterday. What's the bond market really looking at?
You know, I think the bond market is looking at a variety of issues, and the answers are unknown. I mean, think about the wild week we've had here, Brian, and we're actually almost exactly unchanged on a 10-year. We closed at 408 last Friday. We closed at 408 yesterday. And here we sit at 408. And Michigan, you know, I'll tell you what, University of Michigan was really weak. Some of the components like current account, they were exceptionally weak. And to be fair, it seems though University of Michigan kind of has gone off the rails because it is supposed to correlate with equities on some level, and it just doesn't seem to do that much anymore. If you look at the week on the 10-year, you could clearly see on Wednesday, yields shot up. Why? Nervousness over increased supply down the road. On Thursday, yesterday, they went back down, and that was because of Challenger layoffs. But in the end, here we sit. And I think it's quite incredible. So I think the closing is more about no data. And without data, it really is a hamstrung market to some extent. Here's something interesting. December Fed Fund futures. Now, forget all the percentages and everything. Just look at the chart. Now, on the left side is the last Fed meeting. So after the Fed meeting, price dropped. Well, when the price drops, that is pricing in less aggressive easing. So what happened is, before the Fed loosened on its last move, we were at basically 100% of a December rate cut. Now we're hovering right around in the 60s, sometime in the 70s, and even though it's still built in, it's close enough to 50% that should the Fed start to put some guidance out before the meeting, they could probably turn the market around. So we want to pay very close attention to that contract. Brian, back to you.